Well, the three new certainties in markets right now for investors are potentially higher gold, oil, and defense investments amid rising Middle East tension. My name's Jessica Amir, a market strategist here with Mumu. It's great to have your company on this 16th day of June. Well, with Iran striking back on Israel after its attacks and the US mulling involvement, it seems investors are bracing for further impacts on markets and a broad risk off mood. And they could also expect higher levels for oil, defense, and gold investments. Now, after just 3 days of conflict, we've already seen spiking oil prices. Let's just bring those into the fold right now, flashing that onto the screen. We can see oil, it's up 7% to $76.94 USA barrel. That's the highest level we've seen for oil since January. Oil, wait for it, it's now up about 20% in 5 days. Gold is also back at record all-time highs. Defense stocks, they're charging. Indeed, think about Raytheon, the world's biggest missile company. Their shares hit a brand new record all-time high on Friday. And broadening out the argument, speaking about defense, we've been speaking a lot about that here at Mumu. Defense ETFs are also at record all-time highs. While airline stocks are in the doldrums, they're crash landing lower. What's really important to remember is that all of this is coming this week while we do have the Fed meeting. This could also add selling pressure to markets. While we also have investors probably going to question how long on earth this new tension is going to go on for. There's questions about if the Strait of Hormuz will be blocked. Of course, that will cut off about 20% of the world's oil supply. So many will be questioning that. And I suspect that's precisely why some are betting the oil prices could get to $95 a barrel. That's just something for you to consider. As we said, the oil price is now at about $74. So the concern is this could cause inflation to spike further. That is not good. Not good when we said we do have several central banks, such as the Fed, meeting this week. We've also got the Bank of Japan, other central banks meeting as well, including Switzerland and Sweden. But of course, everything is focused on the Fed, the US central bank, arguably the most important pulling bank of them all. Now, concern is if we do see the Fed suggest rising uncertainty around trade, rising concerns about inflation, this could trigger further selling in consumer discretionary stocks. So we've put on the screen one of the biggest airlines in the world, United. Of course, this is not only linked to oil prices going higher, that's been a big price pressure for this stock, but also globally, think about airlines. About 25% of their expenses are, thanks very much, a diesel or rather a jet fuel. So with the higher price of oil, down come the airline stocks. But of course, then think about consumer discretionary. Who wants to go out and travel when you do have higher prices for oil? You're paying 20% higher for your petrol than you were prior month. So that's something for you to think about. So United Air, putting this into context, you can see for those that are tuning in on the podcast, we're basically illustrating the demise of United shares. They're down 12% in 5 days. On top of that, don't forget we spoke about Qantas and Flight Centre and corporate travel as well. We spoke about them as well coming under pressure on Friday. All of those three stocks fall about 5% each. So that is something that you would be expecting today on the ASX and perhaps this week. For as long as you see oil prices creeping up, you'd obviously expect lower airline stocks. More broadly, what does this mean? Well, I think you should expect investors to sell out of tech, airlines, and move into those defensive sectors, such as defense specifically. For example, the world's biggest defense ETFs, and also to also move into gold and oil. But for the Aussie share market, is not expected to fare as poorly as the US, and that's because a big chunk of our market are obviously oil and gas and gold stocks as well. But broadly, I do expect investors to come out of tech and consumer discretionary investments and really focus on those key benefactors that are going to be rising in wartime tension. Also, really want you to think about the potential demise of airlines here. Speaking about that correlation, it's a negative correlation. So when we see higher oil prices, we see lower airline stocks. And this brings Virgin into the argument. Virgin expected to list on the ASX about this time next week. So not a very good time for Virgin to be listing. In fact, it's a terrible time, let's be honest, because we've seen already oil prices go up at 20%. And typically, when we see higher oil prices, this puts compounding pressure on forward earnings and profit growth. And that is why airline shares should be expected to fall for as long as oil is higher. On the ASX on Friday, do keep an eye on the fact that we have seen higher levels in Karoon Energy and Woodside. So Karoon Energy was up markedly, up 11%. So well done to you if you were backing into that stock. Woodside, Australia's biggest oil and gas stock, that rose 7.4% on Friday. It's also one of the biggest oil and gas stocks in the world. But a couple of things really to pause and reflect on oil here. One of those is that you should expect a short squeeze in oil stocks. So Bloomberg has published today short selling positions from 2 weeks ago, saying that Viva Energy was one of the most shorted stocks on the ASX in the week closing June 6. Now, sure, this was a couple of weeks ago, but it really highlights the fact that investors have been betting the oil stocks were going to go down. And now, as we said, we've got oil prices moving markedly higher. We're probably going to see a short squeeze. This basically means technical buying could also add further gusto and further momentum and put upward pressure on oil and gas stocks, pushing them even higher. Speaking about going even higher, let's bring in another stock into the equation. Here's Woodside. I want you to think about Woodside. Why is that? Well, we spoke about them seeing one of the biggest moves on the ASX in the ASX 200 on Friday. They were the second best performer. But of course, today, Santos Oil was tapped on the shoulder. They've agreed to be taken over for $30 billion, $8.89 a share. This basically means that once Santos gets taken over, Woodside, their position and weighting in the ASX in the oil and gas sector would increase. So this also means further buying should be expected in Woodside because their piece of the ASX 200 pie should be expected to rise vis-a-vis when buying rises, price pressure does too. Lastly, don't forget that we do have gold at a record all-time high. Keep an eye on stocks that we saw on Friday, making higher ground yet again. Capricorn Metals, Westgold Resources, and Newmont all saw significant moves between 5 and 7%. For as long as we've got rising tension in the Middle East, you'd expect gold to also hit higher levels. So keep an eye on gold stocks as well. Thanks for your company. See you tomorrow.